Hello and welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Will the market go up? Will it go down? And how to manage my portfolio during this volatility? Now that's a question that's bound to have crossed our viewers' minds in the recent market turbulence. So this week, we've decided to put the spotlight on a relatively new investment avenue. We're talking about structured products, a slightly advanced investment concept that promises to enhance portfolio returns. And to help us navigate through it, we have with us Feroz Aziz of Anand Rathi Private Wealth Management, who's joining us on the show today. Feroz, thank you so much for taking out the time. It's good to have you on. Now, the term structured products, I think, became a little familiar to the Indian market back in 2005-06, if I'm not mistaken. That's where we started, kind of dabbling in this concept. But for those who've been left untouched, let's start with the basics. What is a structured product?
See, structured products, but the nomenclature looks a little more complicated, but it's actually a very simple concept. When you buy a bond from a corporate, the returns of that bond are generally fixed as 8, 9, 10, 12%, depending on the company who is issuing the bond. Unlike those bonds, these are nothing but bonds whose returns are not fixed, but they are market linked.
Okay.
For example, they say at these levels of the market, this is the return you're going to get. You might get a 2% return or even an 18% return. The dependency on of the return would no more be a fixed number like 8, 10, 12%, but it's going to be market dependent. So it's a very, very good method to navigate the markets, like you were just saying. In the short run, when the volatility is there and it becomes very difficult to live through the volatility to see the benefit of the long term, this actually brings in some degree of stability to the portfolio because it gives you a 2-year, 3-year perspective on the market and is actually an inherent debt instrument with a flavor of equity.
So it's basically a bond that's wrapped with an additional instrument, thereby giving it that scope of the enhanced return. What is that additional instrument? Are we talking derivatives here?
Correct. Yeah, there is some degree of a smaller degree, a significantly smaller degree of derivative combined with debt to give you the similar payoff of saying that markets would go up, let's assume 10%, you will make 15%. So it gives you a multiple on the market. To answer your question, yes. Derivatives, long-dated derivatives, not the 1, 2, 3 month derivatives, long-dated derivatives.
How long when you say long? Because, the reason I'm asking this is that derivatives became a universally hated or bad word, after the 2008 subprime crisis. So therefore, for viewers who might be a little circumspect about getting into a product that seems a little complex, when you say long-dated derivatives, how would that be different from, a shorter-term security?
Derivatives can be used for several purposes. Like you absolutely rightly pointed out, people became a little circumspect after 2008, where there was large attribution of this whole crisis to derivative being mismanaged. So derivative can actually be used for hedging, speculation, or extreme speculation, leverage and stuff. But if you mix derivative in a very small quantity, it becomes a very good instrument to create a payoff. Now coming back to the point of how long-term, 2-3 year derivatives, which is little known, that NSE has 1, 2, 3 month derivatives which a normal broker actually highlights to his client, but there are on NSE derivatives which are 1, 2, 3 and up to 5 years which are there. Generally institutions deal in it, and then you combine it with debt, can give you a payoff which a normal investor is not able to replicate. So that's a structured product in a nutshell.
So then let's get some more hygiene elements out of the way. I understand that the market size of this product is around 10,000 crore rupees right now. But how liquid is this market? Who all is trading into them? And who's regulating this market? So as an investor, I want to be absolutely sure that this is, a very liquid and very well-regulated market that I'm entering.
See, absolutely. Since the derivative is just a secret of what it goes in, the client actually does not have to be very concerned on the liquidity of the underlying derivative. It's a bond. Okay, so these bonds sometimes are listed, sometimes are not listed on the exchange. If they're listed or unlisted, the issuer generally buys them back. From a client's perspective who has bought a 3-year structured product, but after 1.5 years wants to unwind it or make good his investment and take the money back, the issuer of the bond, like the corporate which is issuing the bond, will generally buy it back. So liquidity is extensively there from a perspective of a buyback. Just like in mutual fund units, when you go to sell your mutual fund units, the mutual fund company buys them back and you actually don't have to find a buyer for the mutual fund units. Similarly, the issuer finds a price and gives you a price and buys that back from you. So liquidity is reasonably good. The other very important aspect which you rightly pointed out is regulation. So regulation is a very good mechanism for an investor to derive comfort out of, saying that is this one instrument I can participate in. So if you look at regulation, these NBFCs, which are the issuers of these bonds, are regulated by RBI. So RBI extensively regulates any issuance and money collection by these NBFCs. So it is in effect regulated by RBI.
And NBFCs, like, if you could give some examples of the actual issuers of these bonds?
Yeah, so NBFCs, there are a couple of MNC, multinational NBFCs, like Citi and Deutsche and all these companies. In the Indian fraternity, you have Reliance, Edelweiss, Anand Rathi is one of the largest issuers. So these are the few issuers, NBFCs, and they're regulated by RBI. But when it comes to listed debentures, then SEBI also steps in because it's listed. So these are the regulations. So it's very well regulated kind of mechanism.
Okay, absolutely. So just talking a little more about now the nature of the product. Is this a customized product that is, a structure is created per client as per his need, or is it like going to the mall with some pre-designed sizes, either a medium, small or large, and you figure out what you fit into? So how are these structures created, and what is the threshold of investing in them?
Threshold is generally on the higher side. Like you said, it is for more sophisticated HNI kind of community. So 25 lakhs is the minimum amount which is invested in these debentures. Now coming to
that's a RBI mandated or SEBI mandated threshold.
Absolutely.
I'm guessing.
It's a RBI mandated threshold. That 25 lakhs becomes the minimum to make sure that the end user of these debentures has a clear understanding of what he is getting into. Thresholds generally become regulators' good mechanism to filter out people who might not be able to interpret what they're getting into. So coming back to whether it's customized or is tailor-made or it is one size fits all, it is somewhere in the middle. So like a mutual fund can't be customized at all. Here a structured product can be customized. You will have a smaller group of people who would be like-minded who will participate. But there are some very large investors, which is far and few between, who say this is exactly what I want and I don't mind putting in a couple of crores to get that degree of customization. So it is somewhere between a mutual fund to something which is a PMS, which is completely customized on the equity category. So it is, I would say, on a scale of 1 to 10, it would fall 5, 6 on customization, where mutual fund falls 1 on customization.
Okay, fair enough. Well, we've only gotten started on structured products. We're going to take a quick break, and on the other side, get down to understanding the different types of structured products. And then the million-dollar question, or the 25 lakh rupee question: why should you use structured products anyway? How do they compare with certain other instruments? All that after a break.